the chat if you can hear both of us, if you can see us. Good to see y'all. We got the full Fund Launch community out today. This is amazing. So today's call is going to be pretty fun. We've done you guys have probably been on webinars in the past with us. We've talked about a variety of things, but today we're actually talking about a fund that we have launched. We've run this now for how many months?
About 9 months.
About 9 months. Yeah. And this is the first time we are really publicly talking about it to y'all. And so we're going to give you the inside scoop on what's going on with Fund Launch Partners, GP Stakes. Last year, we committed $6 million to Fund Launch members' funds. We're actually writing checks into these funds. Now, before we even get going, and by the way, this is not pre-recorded. Someone in the chat thinks it's pre-recorded. This is not pre-recorded. This is totally live. We want to take your questions. I know me and Lincoln are pretty good on camera, but we're not that good on camera, okay? We're not that good to do it all. So we're live here today. We're going to be talking about GP Stakes. Maybe flash our slide here. Let's make sure this is working. Boom, there's the slide. So we're going to be talking about GP Stakes. Now, before we get in, I am very curious in the chat, on a scale of 1 to 10, how much do you know about GP Stakes? 1 would be like I'm a brand new beginner. I haven't heard much. 10 would be I run my own GP Stakes firm. Like I'm heavily involved in GP Stakes. So type in the chat, 1 to 10, where do you fall?
Okay, a lot of 1s. We're seeing some 7s there. We got some
0.5.
All right. Well, look, hey, we'll try to cater to this to someone who doesn't know too much about GP Stakes before, but then we'll get into some details as we go.
Yeah, we'll go basic all the way to super advanced, and we'll stay on for Q&A as well. So we're planning to talk here for just let's call it 20 minutes, 25 minutes. And then the majority is going to be Q&A with y'all. So we can answer questions, talk with you guys, and go from there. It should be a pretty fun and efficient webinar as we get in.
I mean, it's really funny, though, the industry as a whole, right? Like, I mean, we went to the Greenwich Economic Forum. We've been going for the past couple of years. And last year...
This is 200 people, all mostly Wall Street. This is Ray Dalio speaks at it. David Rubenstein's there.
All the big firms, asset management firms. And, last year, the theme was private credit, right? Private credit, secondaries, and GP Stakes, GP seeding. So they were talking a lot about it. I don't know if any of you guys follow Tony Robbins. Like last year, he came out with a book about GP Stakes. He called it the Holy Grail of investing. Look, Tony's done a lot of finance stuff. So to call something the Holy Grail of investing is kind of meaningful.
Well, it's funny. I was with Tony last week. So I was about 25 of us in a private mastermind. I was with Tony Robbins, shook his hand, got to meet him, and with his head of his family office, Tony Robbins' personal family office there. His name's AJ. We talked extensively about GP Stakes. This is you could call it one of the hottest asset classes right now on Wall Street. A lot of people are talking about the space because of the amazing economics behind GP Stakes. So if you haven't heard of GP Stakes, welcome to the party. This is going to be a fun call for you to learn about it. Additionally, we're going to talk about how we're approaching the market in a very unique and specific way. So we're excited to walk through this with y'all.
Yeah.
Everyone ready to go?
Let's get into this.
Let's get going. So maybe share our screen, Kendall. See if we can see it there. Perfect. You guys can see our screen. We'll dive in.
Well, look, before we get going, we got to give it a disclaimer here. First and foremost, these slides are not at a, solicitation of a security. You need to review the prospectus, the PPM, the LPA, all the legal docs. Furthermore, we're not financial advisors. We're going to be talking a lot about alternative investments. So, this isn't financial advice or investment advice. We are going to be talking about an opportunity today that is meant for accredited investors only. So an accredited investor, if you have a net worth more than $1 million, excluding your primary residence, or if you're single, income of more than $200K for the past 2 years, or married filed jointly more than $300K for the past 2 years. So, look, you've been disclosed, you've been disclaimed, right? But yeah, look, let's jump into this opportunity a little bit.
Yeah, let me frame this, and maybe Kendall, if you can put our picture maybe in a different corner, just so people can see some of the stuff here on the slides. Thank you. Like we said before, this is a hot asset class.
Yeah.
So. And we believe there are tectonic plates right now shifting in the world, specifically of GP Stakes. This has been many family offices, billionaires, Wall Street people discussing and trying to enter in this space in any way, shape, or form. And in the next few minutes, we want to walk through, number one, what GP Stakes is, why it's such a hot asset class, but furthermore, why we are so uniquely positioned to capitalize on GP Stakes, probably better than any firm on earth. We've been looking at this now for over 18 months. We launched this firm about, let's call it 10 months ago. Yeah. We've now started to deploy in deals. To get this, we have reviewed 900 plus funds in the last year, Lincoln and his team, and we've written 6 checks. So, and for about $6 million total so far.
Yeah.
We have a very scrutinized process on this, on how we're approaching the market. But I'm excited for you guys to be in here. In this call, we're going to walk you through the basics all the way up to the advance of GP stakes. And at the end, we're actually going to review a few of these 6 deals we did. We're actually going to walk you through the deal mechanics and show you why we are so excited about GP stakes. So all that being said, it's going to be a fun day. If you can, I'm going to ask you right now, people on the call, put away your laptop, put away your email, put away social media. People in the chat, please don't self-promote yourself. We'll delete your chat as well if you're trying to put links in there. If I can ask you, I promise this may be one of the most important calls you join. Not even if you invest or join us, just by understanding this asset class of GP stakes, because I believe you're going to continue to hear about this asset class for the coming months and years in the future. So with that, let's dive in, Lincoln.
Let's do it. Well, look, actually, I would love if we start to kind of tee up this entire opportunity for us here, talk us through the inception story of Fund Launch, because it builds, it's the pillars that we built, we launched this fund off of. So why don't you start there?
Yeah. Many of you have heard my story, but many of you haven't as well. So I started my first fund. I was in college and I was wanting to launch, I was trying to do business. I was trying to be an entrepreneur. I had all these ideas. In college, I come to find out my dad was running a deca-billion-dollar family of real estate funds. My dad drove a car with a dent in the door, just kind of a normal dude. Come to find out he's running these huge funds. So I sit down with my dad. I walk through funds. He starts teaching me about investment funds. Long story short, I end up launching my own fund in college. I pitch my dad for money. My dad says no. And you guys know the story. To date, he's never invested in any of our funds. We've launched now multiple funds since then. And he started to teach me about how funds are put together. So I launched a debt fund, a private credit fund in college. I then launched a second fund. That fund did extremely well. I ran that for 3.5 years, had millions of dollars. We flowed through that product. It did phenomenal. We then sold that fund. And we had a lot of people asking myself, my dad, my brother is also an investment funds attorney. How do you do funds? Like, how do funds even work? How did a couple of guys, we're not in Wall Street. We didn't come from Ivy League backgrounds. We're in Utah, for crying out loud. How did a couple of guys out of Utah break into this fund space in a very unique way? And my dad's now retired from his firm. Their firm, though, is now over $50 billion, just sold to Apollo Group last week for $1.5 billion. My brother, chief compliance officer at a multi-$100 million fund, now just moved to a different firm and has done some phenomenal things. So we started to build, as you can see on the slide here, we started with free content on YouTube, which then turned into a course. Now, when most people launch like a course online or something, you hope 100 people take it, or maybe 1,000. We've had 100,000 people take one of our courses online about funds. By far the largest group on the internet talking about the investment funds. Is anybody in the chat taken one of our courses? Like, type a yes in the chat if you've gone through some of our content and some of our courses in the past. It's been phenomenal. We then launched, we see the Fund Academy. We've done events all the way down to Black Card. A lot of people started needing more help with their funds. So we said, what if we did an incubator to really go the extra mile?
So really just listen to our clients, right? Yeah. They'd say, hey, well, what law firm do I use? There's 50 different law firms out there that are trying to sell you on a master feeder fund structure with a foreign blocker entity, and they're going to charge you $100,000 to set that up. So we went out and negotiated that down to bulk pricing. How do I build a pitch deck? How do I build a data room? What investors do I go raise from? Just like, how do I do compliance? How do I do back office, admin? All the stuff like, when we put that into a fund in a box product. And, the purpose of Black Card is to get someone to the start line, right? To launch a fund, right? Get the business set up. But and
I'll add, so if someone joins Black Card, we have 15 different coaches that help them. We have a pitch deck designer. We have 8 different law firms. We have compliance, admin, all the stuff they need to launch their fund, which has been phenomenal. You see there, we had 1,900 plus members come through Black Card. It's been amazing to be a part of.
Yeah.
But then continuing on,
look, a lot of them, got set up, but look, the reality is running a fund is difficult. Okay. There's all sorts of things you have to deal with, from back office and, these compliance reports and dealing with the SEC and investor relations and, how do they build the business of funds? And over the years, it's funny, Bridger and I, we kept getting asked, and Adam, who's not with us today, but we kept getting asked, hey, will you guys partner with us? Like, we'd love to have you guys on our team as we build this business.
And for a long time, we didn't feel like we were quite ready. We were building out Black Card. All these programs and things. Lincoln's got extensive experience in the fund management space with JP Morgan. I've now ran multiple funds. Adam's worked on huge multi-billion-dollar funds.
Yeah.
But for a long time, we said, no, we're building the core here. But finally, last year, we said, what if? What if we started actually partnering with these firms? What if we started working with them? And we went down to the whiteboard and said, well, if we're going to do it, we got to do it right.
Yeah.
And we got to really provide a world-class value to them and make it be phenomenal. That's where we came up with
how can we create the best opportunity for our investor base and the best opportunity and deliver what these emerging managers actually need, from a partnership structure. And that's where we landed on Fund Launch Partners. So, as we took a step back, we realized that we had built this deal flow machine for a GP stakes GP seeding fund. And we said, look, we got to move forward on this. So we did. But before we get too deep into this, I think it's healthy, for those that put a 1 in the chat, let's just paint a picture here, big picture, what we're talking about.
Yeah. What even is what is a fund? So maybe people that are brand new, like what is a fund? What is GP stakes? What are we even talking about here? So this chart you'll see, let's just go basic for a second.
Super basic.
Yeah. You hear this term of alternative investments or assets. So, you see one of the arrows pointing to there's private equity, real estate funds, venture capital funds, hedge funds, private credit. Like, what does that even mean? So let me just go basic here, and I'm going to use my hands to kind of draw a picture. All a fund is, if you want to put me full screen for a second, all a fund is just a pool of money. Investors are putting money into that pool. Fund managers are drawing from that pool, going and making investments, buying assets. Whenever those assets make money, the money flows back to the pool and we split the returns. So for example, a real estate fund, we'd say, hey, we're pooling money together into a pool. We're going to go buy a big building. Whenever the building makes money, we're just going to split the returns. That would be a real estate investment fund.
Yeah.
A private equity fund, okay? Same exact thing. It's a pool of money. We pull money together. Instead of buying real estate, though, we buy private equity, which is private businesses or just businesses. So we're going to go buy Sycamore Partners on Wall Street. They bought Kohl's Department Store, Nine West Shoes, Aeropostale, Staples. That's a private equity firm.
Yeah.
A hedge fund.
Instead of you might go buy an ETF, which is, a bucket of different public equities. A hedge fund is trading in and out of, they feel like they've got an edge in the marketplace, a better way to trade, to participate in the,
it's a pool.
Markets.
It's a pool of money.
Pool of money.
Instead of buying real estate or private businesses, they're buying public securities. So go back to our slide here for a second. So you can see here, venture capital. It's a pool of money. Instead of buying real estate or stocks and bonds, they do like Shark Tank. They invest into early stage startups.
Yep.
Private credit.
It's a fancy word for not a bank lending you money, right? Any other lender, if you need a debt instrument, that's private credit, right? And there's all these private credit funds that will lend to, real assets or companies, businesses, anything, to support those businesses. So that is alts in a big picture.
Alternative investments, private funds. That's kind of the world that we're talking about here.
And the key thing about private markets is they need to be actively managed, right? It requires sometimes you'll hear the word sponsor or general partner or manager or operator, right? To manage and execute on these strategies. But before we get too deep into this, we've got an asset allocation slide here on the page. And look, not financial advice, but this is the asset allocation breakdown. If you look at this chart of family offices that have between 500 million and $1 billion in AUM. And if you look at their asset allocation, like the point that we're trying to make is that almost 50% of their exposure is in alternative investments, right? So alts, right? So why is almost half of their allocation in alternatives?
And I'll add this, 30 years ago, this was not the case.
No.
Family offices have learned over the last 30 years that they have added more and more and more of their portfolio to alternative investments like private equity, real estate, venture capital, hedge funds.
Yeah.
Because it's, well, you can describe that.
Yeah. I mean, look, so, these private market funds, sorry.
Well, I was gonna say, why would they do this? Why would they add so much towards alts? Why are family offices getting so much towards
private
alts?
Markets? Why do they invest in them? Ultimately, when you break it down and you look at the numbers, they perform better than the public markets, or they perform better than the stocks, right? A big thing about investing, again, not financial advice, but is diversification, right? alternative investments provide you very strong diversification from your traditional stocks or bonds or anything that you have with your financial advisor. So if you just look at the historical performance, it's because they're uncorrelated with traditional investments and they outperform them. So that's why people go to them.
So now, furthermore, let's talk about what is GP stake. So hopefully you guys are getting there, and maybe in the chat, if actually this is a good question. If you've ever invested into a private fund, type of one in the chat if you've ever invested into a fund before. Many people haven't. It's this, a lot of people are saying, man, I'm new to this alt space. Some people have invested into a lot of them. Type of one though, if you have invested in this before, we gotta want to get people up to speed. I love it. Thank you all.
Yeah.
So now, what are GP stakes? Let's go the next layer deeper. So what are we doing? So this is a beautiful graph here explaining what we do, okay, with Fund Launch Partners. So Fund Launch Partners is a fund, that gold box at the top, we bring capital together and we invest into a number of funds below. So you see here a real estate fund, private equity, venture capital. So we actually allocate into these funds. Now, furthermore, you may have heard of like a fund of funds before.
Yeah.
So that would describe a fund of funds. There's a fund that invests into other funds. Now, this is the cool part though. We don't just invest in these funds. If you look at this beautiful slide that me and Lincoln put together very well on our graphic design skills, there's a little green box in the corner, okay? That green box represents a stake or ownership in the firm. So Fund Launch Partners, we invest into a real estate fund, but we also get ownership in the management group. So we actually get a stake of the GP or of the general partner of the firm. Furthermore, we oftentimes invest in preferred terms, in no fee or no carry. We'll explain what that means in a minute. But is this making sense? You guys following along? So we're a firm. Last year, we, for example, did 6 deals.
Yeah, we reviewed 900 funds. We selected our favorite 6. We invested into their strategies. But because we're partnering with these firms at inception, right? We're identifying these firms when they're just getting off the ground and they need additional help. We're able to work with them and acquire an additional 7 to 12% interest in their businesses. So, and that provides some meaningful alpha, meaningful upside for our investors because we're working for that stake in the business. So, to break this down a little further, I think it's healthy to just talk about some of the characteristics here of a GP stake investment. But, recap. An investor in Fund Launch Partners is going to invest in 20 to 25 different funds in the private market space. So why do we like this investment? First and foremost is predictable cash flow, right? So there's 2 ways that a fund makes money. There's a management fee and there's a performance fee. So the management fee is typically on average a 2% management fee on assets under management. So if you're managing $100 million, then you'll collect $2 million a year for the term of that fund. The other way that a fund makes money is a performance fee. So on the upside, so if they'll usually split the profits where the general partner or GP is going to take 20% and the limited partners or investors are going to take 80%. So we come in and we essentially, because we're partnering with them at inception, we're acquiring 7% of their 2% and 7% of their 20% as well. But predictable cash flow. Look, these management fees, despite performance, are going to come in, right? Mm-hmm. They are recession resistant, and it is fee income that is contractually obligated, from the investors to the managers that we get to participate in. Yep. So that's the first thing why we like this. Second is sector diversification, right? Like when an investment in Fund Launch Partners, you are getting a basket, a massive exposure to the alternative investment landscape in general, right? You're getting VC exposure and private equity exposure and private credit exposure. Right now we got, an oil and gas exposure.
So by writing one check into Fund Launch Partners, you get exposure to, let's call it 20 different firms beneath it, which is pretty interesting.
Furthermore, right, I think a lot of people on this webinar are more probably high net worth investors. So it's important to understand that, if you had an extra, let's call it, 500K, right? If you were to go, and a lot of funds have minimums of 250, 500K, $1 million, you could only choose one of those funds to invest in, right? So in order to get exposure to 20 funds, you need to have, if on an average check of 500K, you need to have 10 million ready to go, right? But through this investment, you get extreme diversification in the private markets just through one check alone, which is pretty unique. And then lastly, look, guys, I don't want to get too nerdy here, but I am elated about this investment just because of the downside protection we have built into these structures with asymmetrical upside for our LPs. So, the downside protection is largely due from the management fee that we're participating in and helping these firms, build their businesses. But as these firms build and grow, we get to participate right alongside with them, right? And this is, look, we're
going to show some numbers in a second and break down some deals to show, an investor if you went directly into one of these funds, you'd get maybe a 17% return.
Yeah.
Through us, you'd get a 23, 24, 25 because of the negotiating on these deals we've done.
Yeah. But look, our partners love us as well. Like, we're providing a need for them, right? Like, they need somebody that they could call at 9 o'clock at night as they're working through their audit or working, strategizing a deal with an investor or a deal or putting their investment committee together and becoming an institutional grade firm. And so, we're working for that, right? We're putting in time, sweat, effort into building these firms, and that's what provides the asymmetrical upside for our investors. So let's shift a little bit and talk about why right now.
Yeah, I mentioned at the beginning, we believe there's a very interesting timing right now in the market.
Yeah.
Let's have you talk about this first slide here. Yeah.
So look, here's the breakdown. This slide shows check size by competition. So there's a lot of GP stakes funds out there. And with any asset class, they typically start with like the biggest deals. The biggest deals are always done first, right? And then they start to go downstream and participate in smaller opportunities. What we identified, honestly, through our business and through Fund Launch Partners is that the micro emerging fund manager, anyone raising less than 100 million, they are grossly misunderserved, right? They need help. And there are not a lot of solutions for the emerging micro fund manager. And so, what we see happening right now is we have all these players up in the bigger end of the market with funds that are raising billions of dollars, right? Their average check being at least $25 to $100 million, as you're seeing on this slide. But nobody's deploying, 0 to 5 million into these small funds that are raising less than 100 million. And so that's where we see a truly a blue ocean opportunity right now. But I don't think it's going to stay like that forever, right? Like, I already know of several firms that want to come downstream and participate. And obviously, as you have more firms, then, right now we see so many phenomenal opportunities.
And furthermore, you already mentioned this, but the deal flow that we have through Fund Launch, back to that slide at the beginning of how many people we have coming through the Fund Launch incubator is phenomenal. It uniquely positions us here where even bigger firms are wanting to look, or we're having talks of they want to come and buy some of our deal flow or work with these firms on the next phase, which is a pretty unique spot that we sit in. Furthermore, on the next slide, if you show, this is just in general, by the way, if some of you guys I know are in our community talking about funds, this looks at excess return on the left there. And then there's years at the bottom for funds that launched on a certain vintage.
Yeah.
Many of you know, there is an interesting statistic here with this chart showing the year a fund launches actually determines a lot of how the performance of that fund is. So you can see here, firms that launched in 2002, for example, performed much worse than funds that launched in 2003. Just 1 year difference, we see a huge order of magnitude difference of excess returns. Now, this chart goes to 2020. Many of the firms in 2021, 2, and 3, the jury's still out. We don't actually know quite yet what the returns are. But our analysis of many firms that we see, because we have the inside scoop on a lot of these funds, is funds that have launched in 2021,
they're not great vintages, right? There was too much capital being deployed in the space at the time, especially like a venture fund that, started in 2021, 22. It's tough, right? They deployed into deals, they too aggressively, but right now, in the private markets, there's blood in the streets, right? And you're seeing it in real estate, you're seeing it in venture, you're seeing it in private equity you might look at that and say, well, gosh, well, isn't that a bad time? Right. But in reality, no, that is the best time, right? Yep. Some of the best funds, if you look back here, were launched out of 2008, right? When you have a market downturn, that creates great buying opportunities for these asset management.
We believe 2025 is a fantastic vintage to launch a fund and these underlying funds. It's going to be pretty fun.
Yeah.
Now, let's just dive into some deals here. So Link, walk us through a few of the deals we've already done. These are deals in our portfolio right now. Walk us through some of these.
Yeah. Look, so we have a very scrutinous due diligence process, but we ultimately selected to work with Tom Wilkinson and Stephen Smith. So Smith at All in Ventures.
Back to what you said, 900 funds we reviewed.
Yeah.
We picked 6. So why did you pick Tom and Stephen?
Yeah. Look, so we really like this group because because they had already done 27 deals before launching their fund one, right? These aren't first-time investors. We look for managers that have already done deals, that already have a track record and performance. They had a track record of north of a 4x DPI on their deals. What does that mean? It means any investor that invested $1 million with them have already gotten paid more than $4 million back, right? So they had real meaningful track record on their investments. We really liked them because we felt like they had a sustainable edge, right? So they are the anchor VC. If any of you guys are local to Utah, they partnered with a nonprofit called iHub, where they work out of the same facility as iHub, which is an incubator for all these new businesses. There's like 200 businesses out of there, and they get to go cherry pick their favorite one. So we felt like, they had a strong, compelling edge. And look, we felt like, I always look for Socratic wisdom in managers. I look for managers that are experts about their investment strategy, but are humble about what they don't. And look, these guys knew venture. They knew venture inside and out, but they just needed help on building an asset management business. And that's why we partnered and invested with them. Smart Asset Capital, industrial real estate fund out of Wisconsin that we partnered with. These guys had been around for 6 years. If any of you guys have looked at industrial real estate space before, the biggest risk with industrial is vacancy, right? And so, because you only have 1 or 2 tenants that dictate if you're cash flowing or not. And I really liked Smart Asset Capital because I felt like they had an incredible ability to lease up their properties. They had been running a realty and property management arm of the business for a number of years. And, we really liked that component. So we partnered and invested with them, and they're performing phenomenally. We have an oil and gas investment, Colin O'Farrell out of Jackson Hole. Oil and gas is a tough market to understand, but this guy's deployed, billions of dollars into this strategy. He's been around for decades. Something I'll just maybe name something really cool that our investors like about our fund is, yes, they can invest in our fund and buy into all of these, but then additionally, if they have a strategic investment need, maybe that's income, or maybe that's a tax offset, we've already done all the diligence and research on these managers so they can come in and invest directly into this firm. Like Colin's deal, for example, has like an 86% tax write-off on year one. So if you need a tax offset, then that's a great opportunity. Again, not financial advice. But look, so that's a benefit.
Let's walk through. We mentioned the mechanics of these deals. Walk me through some numbers here, Link. I think we'll go basic here first, and then we're actually going to pull up some spreadsheets and look at some actual numbers here. So walk me through. If I invest into a fund.
Look, guys, if you're not paying attention, right now is the time to pay attention. All right. This is why I am so excited about Fund Launch Partners and these deals that we're doing. Not only are we adding immense value to our portfolio funds that we're partnering with, but we are generating a phenomenal investment opportunity for the investors in our fund. For example, we target that any fund that we look for at least has a track record of doing a 2.2x, right? That's like our base case. That's what we want to look for. So we underwrite that a fund can generate a 2x.
Now, so again, if you put $1 million in, that would mean you would get $2.2 million out over the course of the fund.
Yep.
Which is usually a 6-year, 7-year time period.
Yeah.
Like 5-year, depends on the fund, but a 2.2x on return on your money.
Yep. Okay. Exactly. So, sorry, not to go to the spreadsheet yet here. So look, we structure our deals in a way where, as I told you at the beginning, we get preferred economics. So by becoming in and we're a GP now on the fund, we can often, invest either at a discounted rate or at no fee, no carry in some instances. And so that gives our investors a bump up on the investment multiple.
So that alone, just a 0.8x bump because there's no fee, no carry in a lot of these cases.
Premium,
yes,
right?
Premium, yep.
We also participate in their fee income. Depending on how much they raise, we get an additional 0.65x multiple. That 20% performance fee. Again, it depends on how they perform, but on average, an estimate of about a 0.7 premium.
And this is because we're owners in the business with them. This is the business income also coming in with us.
Yep. And look, we charge a standard fee structure in our fund, which I'll get to in a minute here. So we take that out, but net to investors, if you had invested in this, in any one of the deals directly at a 2.2, we're able to generate about a 3.78x equity multiple for our investors.
Let me restate this again. This is why family offices around the globe are trying to figure out how do we get more GP stakes exposure. This is why Wall Street did a full, when we were at Greenwich Economic Forum with all the big wigs, they spent like a full half day just talking about GP stakes from right here. If you invest directly, you would get a 2.2x. If you go through a GP stakes, the exact same investment, the investment doesn't change at all, you would get a 3.78x return because you have ownership in the underlying business. Isn't that pretty cool? So you get that delta right there, 2.2 to 3.78, that difference right there is with no increased risk, or a very small increased risk, I guess, of management exposure.
Yeah.
This is why this is one of the most hottest asset classes on Wall Street right now. So maybe pull up the spreadsheet here. Let's actually look at numbers for a second.
So it's funny. I was on a call with an advisor, last week, and I was talking to him about this fund, and I am the type of person that wants to underpromise and overdeliver, right? And so I haven't really talked to investors about the upside of this opportunity very much, but I really, he said, Lincoln, but the way you've structured these agreements, it's there. It's contractually there. Like you should be talking to prospective investors about the upside of this opportunity. Because look, when we are partnering with a firm, it's not just a fund. We're not just doing a fund with them. That's not our angle. We want to help build a firm. We want them to become the next Blackstone, right? And that's what we're good at. That's the skill set that we have. I mean, Adam built the back office of a $6 billion shop. We brought on another guy who raised almost $6 billion. His last fund, one of our advisors, was a $700 million fund, oversubscribed it at like 1.2 billion in a matter of months. So we have the skill sets to scale these businesses. And so that's what we're looking to do. So for this example, this is a firm that we actually have under LOI right now. They target on average about a 2.2x net equity multiple, which you'll see right there. So if you've never looked at a sensitivity analysis, I guess I'll explain that. But a sensitivity will determine the outputs based on the two biggest variables in an investment. So for ours, that is the gross equity multiple that we'll get. So if they do a 2.2, we target about a 3. And then, the biggest determinant in these deals that we're making is how much money do they raise? And as you can see here, the more money they raise, it actually makes our economics better here for the equity multiple. So back on the example we shared was a 2.2. Yep.
So which you see on the top corner there on C54.
Yep.
And now looking at, so what are the returns adjusted on how much money they raise?
So this is kind of our standard deviation of returns that we anticipate with this deal. So if everything went to crap, right? Like if everything did not work, they only raised a few $1,000,000. A 0.5 for us is they actually lost money to their investors. So 1.5, it'd be a 1.76 for our LPs. We target this middle standard, which we think is the most probable outcome.
Click on that so they can actually see.
Sorry.
Highlight.
So we target the middle section here, which is the most probable outcome, is what we anticipate will happen. So that's how we get to a 3.78. So we only underwrite that funds are going to raise 50% of their targeted raise. We only price in one fund. But obviously, if they raise and they hit their performance targets fully, like there's the potential to have it like a 6x equity multiple here. But as you can see, as these firms raise money, we never partner with just for one fund. We always partner to build a firm. That's our objective. So as investors, you get to participate as these firms raise raise dollars, continue to scale. And you'll see on these deals that there's easily 10x equity multiple potential on some of these investments, which again, that's a 10 times your money.
You put $1 million in, it would be a $10 million out.
Right. Yeah. I mean, so look, for this offering, we target a net 3, on average, at least a 3x equity multiple. That's what's on our docs. That's what we are pushing for. We structure our deals. But again, my advisor said, look, Lincoln, you got to start telling people about this upside. And so that's what I'm doing right here. But look, let's get back to the presentation here.
Is that making sense?
Yeah.
So for people, we can do Q&A. Go back to just one slide previous. So again, talking about equity multiples, return on equity. Hopefully this is making a little bit of sense. We can do a Q&A and we can bring this back up if you guys need. But I mean, this is, and if you can maybe even grab that book for me from Tony Robbins. Can one of you guys grab that for me? This is why Tony Robbins wrote this book called The Holy Grail of Investing. He was seeing this is what the big institutions and family offices were doing. Yeah, in this book, if you guys follow Tony Robbins, maybe make me full screen if you can. if you guys follow Tony Robbins, a lot of his financial books are around, hey, I'm going to go invest or find the top people in the world in finance. And what are they doing? Why are the rich getting richer and the poor not figuring it out? And one of the things he wrote, this brand new book, The Holy Grail of Investing, is all around this. He found big family offices could come in, negotiate preferred terms and things. And then they would get these amazing multiples when everybody else would get the average return. And so GP stakes firms, what we're doing is allowing what big, huge groups are doing for the common man and woman to have access to, which is pretty fun.
Yeah. So look, we're essentially a VC for private market managers, right? We look for power law investments, but the reason I'm so passionate about this is because, even in the worst case scenarios, like our risk is sitting in real estate investments, right? It's sitting in
the underlying
private
asset.
credit.
Yeah.
It's sitting in their strategies, right? And so that's where the risk is. The risk is you're taking on a fund of funds level risk but in this investment. But again, as these firms develop and accumulate assets under management, any one of the funds that we partner and invest in has the potential to really return the fund in its entirety. So we think that's
pretty cool.
That's a pretty, very cool element of this strategy.
So let's run through economics here with our fund. So how does our fund work? How's it put together? And then we can answer questions. We can stay on with you guys and go from there. So if you share our slides again, that'd be awesome. So you can see here, we run a pretty standard fund here. So our target raise is $30 million in this offering. We'll share what we've done so far in just a second. The term of this fund is 10 years, pretty standard, 2% management fee, 20% carried interest, 8% pref, and then target return is a 3x net MOIC, so multiple on invested capital like we just shared just a few minutes ago. So pretty a middle of the road standard fund offer. Now let's go to the next slide though. I'll walk you guys through where we're at right now. So far, the team, Lincoln and our full team is, please leave us up there. Yeah, thank you, has done a fantastic job. So far we've raised 19.75 in subscribed commits. That's locked in subscribed commitments to the firm.
Yeah, last year we're kind of doing rolling closes. We didn't know how much money we'd need to execute on this strategy. Like we've gone, we've debated it aggressively. Our first big close was really in December at about $10 million. Then we just held a close at the end of January for about $20 million, as you see here. And, why we're making all this, hullabaloo right now is because we anticipate closing this here end of Q1.
Which is just the next 30 days, this month right here.
So, we already have just under 2 million, 1.95 in signed LOIs. It's a one-page letter of intent for investors to come in. We have 7.4 million that have already verbal committed / in final diligence, like doing background checks and reference calls on us. So like they're right there. They're almost ready to hop on board. And again, we have a good mix of both, a lot of ultra high net worth individuals, some family offices, we're getting some high net worths in here as well. And then we have an additional 26.6 million that I'm in active talks with. They're actively considering, right? Where I've had dialogue with them, recently, and they said, yeah, we're still they're timeline aware. They're actively considering this opportunity. They're working on it, working with their committees, or just trying to make a decision if they come in or not.
This adds up. We are looking to close this at 30 million. I think you show the next slide here.
Yeah,
we are target close of 30 million March 28th. So as you can see here, we're very confident we're going to hit that target and probably be oversubscribed on this.
Yeah, very likely.
We're doing this webinar today with y'all. We got a few hundred people from our community here. We're doing a lunch on Tuesday. And then if you show next steps here, what the plan is. So we're getting commitments in right now. What we're doing is receiving letters of intent. So if you're interested in this opportunity, what we have is a QR code on the screen. You see a link there as well. They can drop in the chat. This allows you, if you're an accredited investor and are considering joining this, we'll send you over the docs. You can do due diligence. You can book a call through this QR code. This QR code would bring up a call. You can book a call. But what we are doing is next Thursday, a week from today, we are accepting letters of intent. These are non-binding LOIs, but what it is doing is a placeholder saying, hey, I'm coming in for, I would like to come in for 600,000 or $1 million or 1.5 million. And what we're doing is accepting all these LOIs in, and then we will see how much we can allocate towards you. If you add this up right now, we're roughly 20 million subscribed, another 2 million of signed LOIs. So let's call that 22 million. We have 7.4 in final due diligence, which that's a high confidence.
Very high probability.
Let's say 5 million of that closes. That puts us for 22 plus 5 to 27. That only leaves us about $3 million left to close out this firm, with $26 million actively considering right now. So we have 26 million. This is not including the people today considering coming in for just the remaining $3 million. So we believe this will be oversubscribed here in the next week. We wanted our community to hear about this before we locked it up. And this is our final close we're looking to do on March 28th. So again, LOIs will be due. These are 1-page letters of intent. This is non-binding, but that's what we're doing. And then after that, you have another 2 weeks to review all docs, have lawyers look through it, whatever you need to do. March 28th, we're having a capital call. We're calling 5% in. And then you are subscribed to the fund, you're in. And we have, how many deals are we looking at right now to actually deploy into?
So we have one under LOI. We have, an additional 3 that we're pursuing, partnership with. I mean, look, this is not, we write a check into these firms and we kick our legs up, right? Like if you talk to any of the firms we've already worked with, like our team is working with these firms intimately, day in, day out, and helping them build their business. And so, it's a win on both sides. It's a win for investors because, you get a profit from our work of building with this. It's a win for, potential clients on the back end. So look, this is a call down fund, FY. So if you anticipate subscribing, if you decide to invest, $250K, it's not due at the end of the month, right? So we would call an initial 5%. And then as we make investments and as our portfolio funds achieve their first closes and final closes, then we'll call down that capital and tranche it in and put it to work.
We wanted to, as you can tell, we think we'll fill this up regardless. We want to do this webinar for y'all to give this group a chance, or our community, to be a part of this. We haven't talked about this much over the last year because we've been doing it and building it, and it's been phenomenal. We said, shoot, we got to let our community have access to this before we do this final closing. So again, if you hit the next 2 slides here, you can click that link. Again, this is for only accredited investors only. What's the average check size coming in?
Right now our average check is closer to, let's see, we have 30 investors. It's like 700,000. I think, if I'm doing my math right. But we have decided that we have plenty of slots left open. So we're fine to take a few $100,000 checks in. That's our absolute floor. On our deck, our official deck, our minimum is 250. But we've decided on this last one, ultimately,
we would like to have our community involved with this.
We'd love to have you guys involved.
So minimum check size is 100,000. That's bare minimum. But average check is about 700,000. So if you're an accredited investor, if that's in the ballpark for you, if you want to talk more, this QR code books a call. You will be talking with myself, Lincoln, or Rylan on here. So make sure you're an accredited investor. You're serious. Our calendars will fill up. But if that's something that's and if you're actively want to pursue this and talk to us further, that's the QR code. That's the link. We're going to be accepting subscriptions by next Thursday. There's only a few, 7 days left till next Thursday. Yeah. So we're accepting the
subscription. It's just an LOI, just an LOI, just to lock in your spot, right? That's what we're asking all of our, current LPs to do.
And it's a non-binding. The reason we're doing this, by the way, is we're receiving non-binding LOIs. We're going to see how much we can allocate to each person. So for example, someone might say, hey, I want to put in $1 million. And we're anticipating being oversubscribed. We might say, I know you wanted to come in for $1 million. We can only allocate 700,000 to your position because of how much we believe we're going to be full. We're going to see with LOI. So that's the reason we're grabbing LOIs from everybody, to see the intent. And then we'll say, hey, you wanted $1 million. Hey, we can only give you 700,000, but we'd love to have you in. Yeah. And we'll go for this first fund close, which we are very excited about. And then what happens as well, to make this clear, you're coming in this final close, you get access to all 6 of the deals we've done last year. The deals we just reviewed that are already raising, All In Ventures, how much have they raised so far?
11.
They've raised 11 million of their 20. SAC.
They're 7.5, I think.
So these funds are already going. We already have, it's not like we're hoping to do, we're doing more deals in the future, but you're already getting into 6 deals that we've already done. This year, we're looking to do maybe another 10 deals or so this year. And you'll get exposure over the next, let's call it 24 months, into roughly 20 funds through this Fund Launch Partners Fund 1.
Yeah. Look, guys, we're elated about this opportunity. I'm elated about the current investments we've already made, and I'm doing my best to help them grow and help, help them build their businesses. So look, we're really excited about this opportunity. We'd love to have you along for the ride.
Can I add something?
Yeah.
So we've got our own money in this deal. We've all invested into this thing. Furthermore, I mentioned my dad at the beginning. He has never invested in a single fund I've done. I've done funds for years and years and years. And just last week, he subscribed to this fund. It was the first, and I got to publicly say that because I said at the beginning, this is the first time my dad has ever invested in a fund I've ever done. Was Fund Launch Partners. He wrote a subscription check 2 weeks ago.
Yeah, he did.
Which is I got John Pennington in, and if you guys have been in our community, you've seen that for a long time. I've talked about that, and my dad's been, hey, he's this old sage. He's run multi-billion-dollar funds, and he said, I'm never going to invest in you. You got to do your own thing. And just a few weeks ago, Lincoln actually got him over the line. He said, shoot, I got to get in this. This looks pretty cool what you guys are doing.
Like I have prioritized strategic LPs. Like that's, I've really looked for strategics. And what are strategics to me? It's an investor that can potentially help any one of my portfolio funds. Right. And so, we have private equity, real estate veterans, right, that have built phenomenal shops in the fund. We have EY Entrepreneurs of the Year. We have, franchising experts. We brought all these different experts as LPs into this fund because I know that, as soon as we're done, wrapping up this close, all I'm doing for the next several years is focusing on building these other funds. Right. Mm-hmm. And so that's what we want to do. Look, I saw a question pop up.
Yeah, let's take some questions. And maybe if you can help us make these bigger so we can read them. Yeah. They're kind of small for us. Maybe we'll get another screen here. But let's hit some questions. We can pull up spreadsheets. We can pull up. We have probably 50 more slides on here. We're happy to talk about whatever. So let's do this though to organize the questions. We have the chat, which is fine. You can drop them there. Also, if you're on Zoom, there's a Q&A box as well that we can read. It's a little bit easier to organize them on the Q&A. So I'd prioritize the Q&A, but if you can't figure that out or find it, you can do the chat as well. We have, and I think this is on other streaming platforms as well. So just pull those up. Our team can pull us up on our screen here so we can read them. We'll hit a couple of these.
Yeah. I saw one that I can just jump into right off the bat, but it says, how do you select the funds that we work with?
Great question. What's the due diligence process?
That's a great question. Yeah. That's probably the most common question I always get. So look, I structured this fund very institutional-like. So basically how it works is I have a screening team that reviews opportunities on a weekly basis. They bring me a 2-page summary of every opportunity based on our core underwriting criteria. Have they done deals? Have they raised money? What market are they in? Do they have an edge, right? Has the team worked together before? What are the biggest risks of the opportunity? Are they mitigating risks? Like, all these core things, they summarize that. I review those every week. I basically then go into, of the ones I go into full due diligence on, right? Again, in the month of January this year, we had 130 applications come in. For people that wanted to work with us, 130. And I go through and I basically narrow it down to my favorite ones. I take those to an investment committee where I brought on guys that all they've done for 20 years. One of the guys, Trenton Smith, like all he's done for 20 years is manager selection. Is select
at a big institution.
Fund. Yeah, he stood up the alts portfolio at Dow and AAA. He's deployed billions of dollars into, primarily first and second time funds. I think he's written 62 LP checks into funds.
And so he's on our investment committee.
He's on our investment committee. I basically bring my favorite deals to IC, and then I have 7 people that just tell me and try and tell me, give me reasons why not to do the deal. And so, we're very scrutinous. In our due diligence process, we do background checks, we do reference calls, we do balance sheet reviews. We review their assets, we do on-site visits. I just had one last week where we go and visit, we walk their assets, if it's real estate, or we go look at their companies. We do very extensive, I would say, institutional grade due diligence in this fund to narrow down to the best and brightest, investments. Look, at the end of the day, we are looking for the best and brightest managers, right? That we feel like we can add immense value to, and that we can help build the business. So that's kind of our selection process.
Yeah. Here, but can you pull up the slide again, just so people can see it? Again, you can book a call here if you want to learn more. You can talk to me, Lincoln, or Rylan, all right there. A few more questions. How do you balance taking the economics in one of these firms without discourage? Is that what it is? Man, I got bad eyes. Can you help make that bigger for
Here,
me?
Adam texted me because it's
Discerning the underlying terms. Are the management fees distributed to investors as they are reinvested?
Yeah, look, we didn't do any fancy waterfall structures. If management fees come in, I mean, our waterfall is a first an 8% pref to our investors, right? So an 8% preferred return, that's annually, right? The second thing that happens in our waterfall, just whether that's management fee coming back, that's, distributions from their assets, whatever, it's first the pref, first the pref to our investors, second principal repayment to our investors, right? So we got to make sure all of our investors, if you invested $1 million, you get $1 million back, right? And then we do a 2% catch up where the general partnership takes the next 2%. So think of it like an 80-20 split with investors getting the first 80. And
I think what you said is very important.
An 80-20 split after that.
That principal's got to be paid back with an 8% pref.
Yeah.
Which is very crucial.
Yeah.
Make sure that happens. Some funds don't do that.
Yep.
And then there's there's economic splits for us.
Yep.
On the back end.
Yep.
Yep.
So, I mean, if that's how the waterfall works.
Yeah.
Let's see. Adam texted me, so I don't have to. I didn't have to squint here.
Possible? Bring my computer up here.
Okay. Are you focused on any hard asset funds? Yeah. Well, look, we look at everything, right? I mean, I have seen, again, 900 funds last year. I mean, we see all types of real estate strategies, private equities. We see luxury goods. We see any sort of commodity, timber, oil, all these unique esoteric, land plays and whatever. But at the end of the day, we're trying to do what's best for our investors. So we look at those. Another question, how are you different from a secondaries fund? So we're not buying.
So we'll maybe explain what secondaries is real
quick.
quick.
Why don't you take that one?
Yeah. So a secondaries fund, you could call it somewhat similar though. A secondaries fund, when there's existing funds, they'll find limited partners in those funds that want to leave.
Yeah.
So if, for example, if you had fund A and you have $1 million investor in there and they're like, I got to get out for whatever reason.
Yeah.
I'll sell my $1 million position on a secondary market for $800,000.
Yeah.
And a firm or somebody would come buy they call it a secondary position from $800,000, but they get the $1 million position because that investor needs liquidity. That's a secondary fund. This is much different because we're actually coming into the GP. We're coming into the ownership structure, and we're coming in at an inception. We're coming at the start, and we're getting preferred economics, no fee, no carry.
Yeah. And look, there's a traditional GP stakes fund is when you are buying interest in a pre-existing asset management firm. Let's see. Did we lose people here? I'm just seeing a Zoom window behind it. But a GP, that's a GP stakes fund is when we are buying interest in a pre-existing asset management fund. Seeding is when you get a fund early and you still participate in the economics, but you're writing a check to the strategy. And that's our primary use case for funds, is that we're deploying into their strategy with LP dollars. And that's what I meant by that's where the risk sits in an investment.
I guess what? I got my computer right here. So
there we go.
I guess we're getting old, dude.
Yeah,
I guess we're getting old.
Guys, I had LASIK a couple years ago, and I'm thinking I might have to go get a tune-up or something.
If you have another question, I'm just seeing the new chat stuff come in, so re-drop it, like put it back in the chat for me, and then I can read it now. Someone's asking will there be a recording on this video later today or something? Yes, we've streamed this to YouTube. So you go to actually our YouTube channel and just see the full recording on. It's under my channel, Bridger Pennington on YouTube, or look up Fund Launch. You'll find our channel. And additionally, we'll send this out in an email to everybody as well. The deadline again is next Thursday, March 13th for just the LOIs, which is a 1-page document. If you hop on a call with us, you can request that from us. We can send it to you of where you're at, and we can send you more docs as well.
Yeah. Look, somebody said, hey, I don't trust you. This is exactly what my advisor said. He said, if I see emerging managers over 4, how can I trust those numbers? Seems high. Look, I'm happy to walk you through the math in depth. Book a call. I will walk you through the financials, right? I mean, look, we are getting extremely advantaged economics in these investments because my team is working day in and day out with these emerging managers to help them get off the ground. I mean, Adam is on late night calls, working through audits. I'm with firms, helping them refine their investment strategies. I mean, there's shared resources between fund launch. I mean, like we are working a lot with these firms.
Furthermore, Adam, you might have a slide on this. We shared earlier about emerging managers, excess returns. I wonder if you have another slide as well, but it's funny. We work in the emerging manager space. Emerging managers actually, and there's a lot on the $1 billion line. Firms over $1 billion have, and maybe put us full screen while he finds this slide for a second. Firms that are over $1 billion versus firms under $1 billion. Firms under $1 billion statistically outperform firms over $1 billion on a percentage return. Once you get over $1 billion, it's just much harder to produce that much yield and return for a firm. Furthermore, smaller funds are more have higher chance to find alpha in more broken or fragmented markets. Because of the size of the check, it's much easier to make a 50% return on $100,000 versus a 50% return on $3 billion.
Yeah.
And because these firms are so small, and if you can look at the beginning stages of KKR or Sequoia or these big firms, they're actually some of their best funds were their first few funds.
Yeah.
Because they were writing much smaller checks, they were more nimble, and there was much more asymmetrical risk to be had with these firms.
Yeah. Furthermore, like I was just demonstrating the upside, right? Like our target return to investors is my base case is a net 3x to investors, right? That is what I am going to do everything in my power to accomplish, right? And if I hit that, I have hit my investors' expectations. So we are targeting a net 3. It's an 18 to 21% IRR. Okay, those are our base case returns. I merely wanted to demonstrate the fact that each one of these investments has asymmetrical upside on the investment opportunity. Okay. That there is extreme upside as any one of these firms materializes and, builds an institutional grade shop. But again, I'm happy to walk you through the numbers in detail of how we're able to, how those numbers can shake out.
A couple other good questions here. Oh, thank you. Maybe put this slide back up once you're ready. Can I invest through a Roth IRA or those kinds of funds?
Yeah. And look, I think we might be frozen on the video, so make sure that's running there. But yes, we through funds, as long as less than 25% of aggregate commitments are ERISA dollars, then we can take those, and they certainly are right now. I mean, we have like a lot of trusts and things like that in already, but yeah, we're well under capacity to take on additional ERISA dollars.
Yeah. Someone asked, are we investing into Bridger's crypto fund? No, that'd be a conflict of interest. We don't invest in that fund. I think we might be frozen. Can you guys still hear us? Hopefully you can hear us. But no, no investment into our blockchain fund. Yeah.
Okay.
Also, there's, again, we've said this before, if you're self-promoting on here with your email and other links, we're going to delete those, just FYI.
Yeah.
So no hard feelings, but you're going to be kicked out. You still have audio, but the video looks frozen. Maybe we'll try to reset it.
Video's frozen, Kendall.
We got great voices though. So
yeah, that's right.
How do you calculate your IRR? How long is like the hold period in this fund? So on the last slide, you can see it's a 10-year term of the fund. So walk us through that.
Yeah. So it's a 10-year fund. However, the average duration of the funds that we invest in is about 6 years. So we anticipate principal repayment by year 6. That is our objective. Now, there is actually a very nice yield component to this strategy, right? As those management fees come back to us or the yield from their assets, we get to, we're going to distribute that back to our LPs. So there's a very strong, yield component to this strategy as well. But yeah, average, we're targeting principal payback by year 6, with the upside coming year 6 through 9.
Very cool. Can you pull up the restream chat on this one? Because I have the other chat. Okay. Good questions, y'all.
Yeah, these are great.
What are the tax implications? So someone invested a certain number of, $100,000 or $1 million. What do the tax implications look like over the next few years?
So all the carry and all the dollars that we invest in their strategies are typically taxed at long-term capital gains, carried interest. The management fee income that comes back to us is taxed at ordinary income.
Mhm.
And so that's, you know, I mean, look, we're not optimizing for tax for our investors, but I mean, that's certainly a component of it here.
So again, if you want to book a call and talk more, see subscription documents, there's a QR code on your screen. You can pull out your phone and scan that, or the link is down below. It's funlaunch.com.click/March 13. Maybe do you want to pull that up on your computer actually? Just show them what it looks like on that
Oh,
link.
yeah. Yeah.
So just pull that open.
Yep.
So if you go here, you'll see a screen like this. Hopefully, yeah, you can see it here. This is just frozen pro, so it's still working. Yeah.
Great.
So you'll see here, hop on a discovery call. These are short, calls, 30 minutes or less.
Yeah.
Put your name in, phone number, email, any additional information we'd like to hear, and then you'll go to the next screen. And again, this is a call not with some random team. This is me, Lincoln, and Rylan are taking these calls, and Adam might hop on a few of these calls as well. We can talk to you guys directly and go from there.
Answer any questions. I mean, the first thing we'll do is we'll get you, as soon as you schedule a call, we'll send you that LOI template that you can use to secure your commitment, and we can go from there.
Furthermore, if you have someone that's not on today's call, you have a friend, a family member, somebody that this might be interesting to, you're welcome to book a call. We can talk to them more, or you can find this recording. We'll send it out via email, and I think it might be on YouTube as well for people to have there.
Yeah. Are you going to have more funds in upcoming months? No. Look, I mean, when we close this, I am going to work and working with these funds on deploying the money we have raised and working with the funds that we partner with for the next several years. So you will not see another offering from us anytime soon.
Yeah, at least soon. We hope to do a Fund Launch Partners Fund 2 or Fund 3, but those will be quite far down the road. Probably we'll have enough money in here to do this for the next probably
several years. I got a question of how do we get paid? It's that same model, like
go back to the previous slide. It'll show it.
Yeah. I see a question of, why are you doing this? How do you guys get paid? So we charge a 2% management fee on our commitments, right, that come into this fund. And then we have a 20% performance fee. So you're not getting typically double feed in this. But yeah, I mean, look, we're, we want to make our investors money, and we're incentivized to perform well on this strategy as well. So,
Angelo, are you only investing in funds that participate in Fund Launch, or do you have other channels to find emerging funds to invest in? So from our deal flow, are we only doing black card funds or Fund Launch funds, or we go outside?
I mean, look, I'll say, and I'm just speaking very candidly here, right? I like the black card funds because they have already taken an actionable step to launch a fund, right? Yeah. I think there's certainly, there may be a bias toward them just because I get to go like anyone in black card, they have like an account manager that works with them. They have all these coaches.
We've seen them. We've met them
at events. Like I've interacted with them. I get to monitor these managers for months or even years, right? Before they, start pushing towards their first close. And so I get to watch them, right? And I mean, that is like the best due diligence I could ever do. Yeah. So but no, they don't have to be a black card fund. We'll certainly partner and invest in those outside of it. I will just say, if you're asked, like they require to be better, right? They just need to be better because there's less of a relationship, with those managers.
Yeah. Question. We already answered this, but are you guys invested in these funds? Yes. So all of the partners, myself, Mason, Lincoln, Adam, we've all written checks into Fund Launch Partners as a whole. And then obviously that goes down into the fund as well.
Yeah. So someone's asking about LPA and PPM. So we have a data room that has any and all information that you could want. Usually, just if you book a call, we'll have your email. And so then we can start coordinating with you. Like even before the call, we'll send you the LOI and we can send you access to the data room and you could review as much, or as little as you can. Yeah. Just this morning, Mason Brains, actually, he just committed an additional 100K because he's so excited about what we're doing. So he said, hey, make sure you hold me a spot for another 100. Look, we're thrilled about this opportunity on both sides of the ball, both for the managers and both for the investors.
Good question from Trip here. Expected cash flow to the investors distributed quarterly and semi-annually. What's the plan there?
Let me just
let's pull the slides.
Let me just share a spreadsheet here.
They can see it. Yeah,
because I get that question a lot. So this is an example of one of the funds that we invested in. They are currently at like 7 million. AUM. Sorry, a little clunky here. Historically, this fund has done about 10% to their investors. They've done about a 10% return.
This is cash flow.
Cash flow from the
This is
strategy.
not return. This is just cash flow.
Yep.
On cash on cash.
So they've already raised 7 of their 20. This is an active deal in the fund, right? That investors get to come in and participate in pari passu. The cash on cash for management fees is about 1.3%. But what becomes very compelling is, as we support these managers and continuing to build the business, I mean, there's potential for a cash on cash of 17% in this opportunity. So that's just, one of many, but there's a very strong potential yield component, in these firms. But, we'll typically tranche in capital as these managers achieve milestones, right? I mean, I don't want to be $1 million investor in a $3 million or $5 million start, right? And so, I want to make sure that I can retain integrity of the strategy and alpha by tranching in capital as they achieve different milestones. And, I think it's a very fair ask on our end for the portfolio managers we work with, and it makes sense. So,
yeah, great questions, y'all. This is great. Good question. Trip Eduardo. I thought the underlying funds you're investing in has a life of 10 years. If so, wouldn't that mean your fund life would be extended? Let's say you invest in fund 3 or a fund 3 years into your own fund. So walk me through the timeline, how this works. So it's a very good question, Eduardo. Yeah.
Great question. Yep. Very sophisticated question. So look, yes, we the average duration is 6 of fund 1s. We typically structure these contracts in a way where we have the right to match additional commitments in subsequent funds. So let's say, first of all, the majority of this fund is going into fund 1s, okay? Or that vintage that we're targeting. So yes, over the next 2 years, we're going to go deploy this capital. So it is possible that 18 months from now, we identify a firm that has a 10-year period. This firm is structured as a 10. So it is possible in that scenario that we would utilize the extensions in our PPM where we have 2 one-year extensions, and we structured it right there at the GP's discretion, if that was the case. But again, as a percent of the portfolio, we're talking that's less than 5% of the portfolio. So we still want to target, that principal's back within the 6, and that's about an average duration of 6 years. But yeah, look, another component to this is that, someone's saying the link does not work. Can somebody make sure that can our team make sure we get an appropriate link?
Try the QR code as well.
Or the QR code if that's not working.
Yeah.
Maybe you guys are crashing out. I don't know how many people on here, but maybe there's too many. Let's see. What was I saying? Furthermore, if anything extends beyond the term after that, we would just roll interest over pari passu into a continuation vehicle, and then split profits 80-20.
Yep. They're good. All right. Did you present the fund the underlying strategies? I think is there any fund strategies we won't do? This is from Keen. So I heard real estate, I heard credit. Is there any crypto in these funds, hedge funds? Is there asset strategy we don't get into?
But I will not do a crypto fund.
Lincoln's not a crypto guy.
I'm not a crypto guy.
And it's okay.
And so, no, probably not a crypto. We'll probably stay away from crypto. I'm actually,
hedge funds. You can talk about hedge
I'm
funds.
probably not good. And yeah, it's not just crypto, but hedge funds are a lot more difficult for me to underwrite, because hedge funds are open-ended vehicles, right? And their, commitments to those funds are not locked in for a period of time. So that makes it a more difficult underwrite on my end, where that fee income is no longer contractual. Where, if you have a bad quarter, a bad year, you could lose all your commitments. So this is largely going to be private market funds. What do I mean by that? It's largely, if you were to force my hand, I'm not doing an asset allocation or driving for a specific asset allocation, but ultimately I get that question a lot because I am manager opportunistic. I'm looking for the best and brightest managers. But I would say that, what is our fund going to look like? It's going to be a function of our deal flow, right? Which is about 1/3 real estate related strategies, 1/3 private equity related strategies, and 1/3 everything else, inclusive of commodities, credit, et cetera. So, but yeah, I mean, look, we are looking for the right managers. You know, I mean,
and have a decent mix amongst these.
yeah,
The
look,
asset classes as well.
I'm heavily invested into this fund. I want to make sure that, you know, I'm building a diversified pool of assets for our investors.
Yeah.
So I'm very conscious to that, and making sure that, you know, it's going to be a robust, healthy portfolio.
Chat as well. If you have questions that we didn't answer yet, just please type them again at the bottom so we can see them. Someone got probably lost up earlier. Let's see. Would you guys like to see? We can show you more the Excel spreadsheet, like under the hood a little bit. We can show you more. Different piece of how we think about it. But that's the take. This is, if hopefully you can tell why we're so excited, why Wall Street's so excited about this, family offices so excited about GP stakes in general. This has been somewhat of a new asset class, at least term GP stakes, and it's becoming more popularized.
Yeah.
Furthermore, like you mentioned, it started in the big ones, where
big
people
ones like Blue Owl, Blackstone.
They're writing
Dyal.
$100 million checks into multi-billion-dollar funds. And we are so uniquely positioned because of the deal flow we have with Fund Launch. We get to see all of you a lot of you coming through are phenomenal investors or business operators. And you come through this incubator and you get refined through Black Card, and it spits out some pretty phenomenal funds that we get to see. Again, 900 funds reviewed last year, down to 6 we did deals on. We have an amazing deal flow. I mean, it's funny. We go talk. So you went to some.
Look,
huge...
I've met with a lot of our competitors, right, upstream, and they actually. I mean, I actually have a call next week with I'm not going to say the name, but with one of the big GP seeding firms, and one of the managing directors wants to put it, potentially make an investment here, just for the alignment of interest, so that as these firms develop. Right. That we have a pre-existing relationship there, so that he can come in and maybe help those firms. Like, look, we want to help these firms go from like $1 million to like 500 million. Right. Like that's our goal. Right. And the other firms their objective is to take them from 500 million to 5 billion. Right. But like, we're starting with these smaller funds and helping them get their foundations, to get their roots, become an institutional recognizable brand and an institutional due process, right? Like that, it is so important. I mean, a lot of people ask me, sorry, I'm going to go on a tangent here just because I think it's an important context, but like, why, how are you able to get these economics first and foremost? Why are you working with these managers? Why do you like them? Right. So let me start by saying there's 2 types of emerging managers we see out in the marketplace. Okay. There is the traditional manager, which typically probably has an Ivy League degree on their resume. They probably worked at a big shop for a number of years, either a big bank or a big firm. They probably have an uncle that's in the business, a brother that's in the business. It's very much like they have what they need to build this business, and they have institutional depth, most importantly, where they have decades of relevant experience in how to build these firms. Like, I'll be straight up, that's probably not our guy, right? Like, we look for the untraditional manager, right? Somebody who you typically came across money, came across wealth, and they just started doing deals, right? They just started investing their own money into strategies, either real estate or buying companies or buying or trading or, whatever. And they had success. And then they started syndicating money, right? And then they started doing well with that. But, that syndicator, they reached this inflection point where they say, look, I want to build this asset management business. I want to build a robust firm. But they don't have the institutional depth, right? They need somebody on their team that has built funds before, that has worked with the SEC before, that works with administrators, that works with all these things that are just very opaque for running and building alternative asset management firms. That is the value prop we deliver. And preferably, I would rather invest in the untraditional manager than the traditional manager. Why? Because they've done deals before, right? Typically, if you're at a big shop, these big institutional grade fund ones, and I think it's largely because part of the industry has such a bad rap there, is because these big fund managers, they've only done one part of the process, right? They've only done investment selection at the beginning, They haven't done value add on those projects. They haven't disposed of they haven't sold those projects.
They haven't found partners. They haven't found investors. They haven't done anything.
Ran a business, right?
Mm-hmm.
But what I love about these emerging fund managers and why I have so much conviction in them is because they have dealt with the crap already of running a business, right? They know how to do deals. They just need steered in the right direction in order to scale these firms. And so that is why I have so much conviction and so much confidence in these emerging managers, is because they've done deals, they've raised money, they are experts in their own right? They just need help and steered in the right direction. And that's what we can do. That's our value add to these companies. So sorry about that.
That was great. I love it.
Get excited about it.
The passion, it is true though. The passion, I think, is warranted because of, we've seen it. We've done this for now, going on 6 years?
I grew up in Idaho. Okay. I am from Shelley, Idaho. I grew up basically on a potato farm. I worked 8 years before graduating high school in the spuds, right? I am passionate about the underdog. Okay. I'm passionate about empowering the underdog. I'm passionate about investing in the underdog. I am an underdog my entire life. And so look, that's what gets me riled up about this.
I love it. That's who we serve.
That's what we're about here.
And we keep seeing them win. That's the cool part. We've been in Fund Launch with Blackcard. Yeah. We keep seeing these untraditional managers keep winning, and they actually find this unique asymmetrical risk in a lot of times very niche asset class, and they can expose it and do extremely well. Something that someone on Wall Street, a traditional manager, would just overlook because it's not even in their purview to do some of these funds that we're looking at, and it's fun to be a part of.
No, it's a thrill, guys. I'm very passionate about this. I love what I'm doing every day. I'm very excited about this opportunity. I'm excited to loop in the community on this as we close things out. Would love to have long-lasting, relationships with you guys. So
someone asked how involved is Bridger in all this? So I sit on an investment committee. Yeah. I'm in the Monday meetings with you guys. Lincoln is I would say the main partner running this shop. We're all in the same office though. We all are right here, next to each other. We're all together. I'm in the meetings. I'm on the investment committee. I help bring partners in, but you guys, Lincoln's, you're the one really pushing and driving on these due diligence.
Yep.
And Adam Campbell as well. But I'm decently involved. I'd say very involved in this process. Let's do this. We're wrapping up here. We're happy to answer plenty of great questions that you guys have. Eduardo asked, somebody said, please answer Eduardo's question from Jay Miller. What's up, Jay? Jay's been on pretty much every webinar we've ever done with Fund Launch, which is awesome. One of the OGs. Maybe 2 more questions. How do you source emerging managers who aren't part of Fund Launch? And number 2, what % of your fund will be Fund Launch managers?
Guys, okay, look, this is not emerging fund managers need help. We have the help. I put up a LinkedIn post in January and said, hey, we're partnering and investing in emerging funds. Submit us an application if you're interested, if you need a partner that's built funds before. Mm-hmm. I had over 100 applications. Okay. I go to a conference. Now I sit on the limited partnership side because I'm deploying into funds. So I go to a conference and I walk away with at least 30 managers that they just need the right partner. Mm-hmm. Right. And look, that's why we typically target less than 10%. That is why we don't want to be a big piece of the cap table. Right. We know that, look, we are going to roll up our sleeves. We are going to work aggressively, these first couple of years in building the business and helping them get, their footing in the business. We're still going to be involved, but we'll take more of a lighter role as these managers really become institutionalized, but that's what they need. So, we don't want to damage the cap table and take too much interest in these firms.
Yep.
We want to leave those economics for the managers so they're well incentivized to keep running the business and building the business. But we have the knowledge and expertise that they lack.
There's not a hard set. We're doing this many Fund Launch managers, this many emerging. We want to serve the best and brightest emerging managers. We see a lot of them through Fund Launch. Yeah. If you can throw the QR code back one more time, that screen.
Yeah.
If you can throw that up, Kendall, that'd be awesome. And then put us in the other corner on there. So again, where we're at, we're happy to answer more questions and talk further. Again, we've got roughly right under 22 million in subscribed commitments. With, if you count the LOIs, we've got 7.4 in final due diligence. That puts us around 20. If some of those fall through,
27.
okay, let's call it 27, 26. We have a further 26 million actively considering beyond that. Some of these are, I mean, some big institutional checks that we're looking at, some big subscribers as well, very sophisticated investors like you've talked about that are in this final conversation this month. We believe we're going to be oversubscribed on this. We wanted our community to have a chance to be a part of this. Again, we're target 30 million. We're closing on March 28th. LOIs are due March 13th. It's a one-page letter of intent. We have it for you. You don't need to come up with your own. We have a letter of intent we'll give to you that you can fill out and say, hey, I'm putting a letter of intent in for X number of dollars. It's non-binding. You can withdraw it if you'd like, but it shows us your level of interest, and then we can move to final due diligence and get you all the stuff. The 28th is the final drop dead close for this. So if you're interested, you want to talk to myself, Lincoln, or Rylan, there's a link right there, QR code. Click on that, book a call. We're going to wrap up here in just a minute or two. We might answer one or two more, but I'd book that link and then we'll talk. We only got 7 days until I can't believe it's already March 13th.
Yeah.
7 days till that, and then we'll go from there.
Yeah. So look, we always I see a question here. What is our projected fund
average fund investment?
Yeah. So look, I mean, we'll average about $1 million, but we have flexibility to go up to 5. I mean, we have a lot of, again, up to this point, I've prioritized strategic LPs, right? So I have LPs that say, yes, I want to invest in your fund, but I also want to go invest in, as this portfolio takes shape, and put additional capital to work in some of your favorites, right? And so I look for those strategic LPs that have something to offer other than just capital. And usually that's either capital to our portcos or a value add to portcos, et cetera. But look to do it that way. So we'll structure it. We'll start small, with, you saw earlier, like as little as 300K up to several $1 million into any of these firms.
Well, I'll share one story. We had a firm early on that we wanted to partner with. We got excited about. They started to launch, and the firm didn't work out. Yeah. The partners kind of fell apart. And guess what?
Divorce.
There was a divorce involved. Yeah. Guess what? We didn't deploy any capital. Yeah. We had no capital at risk because we wait to deploy our capital until they hit certain benchmarks in most of these funds. And so that firm, so imagine like a venture capital firm, right? They always say like you have 20 investments, 10 are going to be losers, 5 are going to break even, and 2 are going to return the whole fund. In our fund, our losers, one of them, they had a divorce, the firm didn't launch. We didn't lose any money. We just lost a little bit of time.
We lost time.
We just lost time. That was it, which is a pretty cool way to mitigate our downside risk.
Yeah. I mean, honestly, look, I have capital preservation at the forefront of, as the forefront objective, trying to protect investor capital at all costs. I'm very conservative in nature. Like I've been a CFO for a number of years. I hedge risks. Okay. And I certainly want to protect downside. So
someone asked, can I borrow against my position in the portfolio? No, at least to our understanding. Maybe that's an outside thing.
That's a commitment to the
you're
fund.
Committing to the fund. You're not going to borrow against it.
Yeah.
Someone else asked, how do I find emerging fund managers? That's what we're good at. That's what we do. We have this amazing pipeline of deal flow because we've built an incredible business with 100,000 members over the last 6 years.
Yeah.
So it is somewhat hard to find emerging managers and the right ones. Again, we vetted 900 funds last year to find 6. It's quite a process to do it. Do you ever structure a fund as a part of an LP funds with some debt financing? As LP funds with some debt financing?
In my mandate, I wrote if you jump into our PPM, I have pretty strong flexibility in how I deploy the capital. I mean, there's got to be a good reason to structure a credit facility, but I mean, I'm more than happy to do it. I'm a partner in these firms. I'm a minority partner, and I want to make sure they succeed. So if, coming in and helping them bridge a financing round is something we got to do, great, let's do it. But ideally, the capital is just LP commitments.
Are all funds located in the U.S.?
That is a priority. I mean, look, and that's where I know I can add a lot of value if they're domiciled domestically, right? I want to make sure that, I mean, look, I know the SEC. I don't know, the SEC equivalent in all,
in Spain
in
or
Spain
in
and
the
yeah,
UK. Yeah.
it's more difficult.
Most
So
of our value adds in the United States
yeah,
and North America.
so look, I mean, that's not to say I won't, right? But that's like, I'm not as confident in my value prop to a manager. If they say, hey, I still want to partner and invest with you, then I have to say, look, man, I don't know your securities loss. I'm not a value add there. I don't know, how your business runs. So it's harder to make a deal work, honestly. And I'm very transparent about that. But I wouldn't be surprised if there's at least a domestic fund that invests, offshore. Because again, we're manager opportunistic. So.
Yeah. Great. Couple of you guys book calls. Awesome. We'll talk to you next week.
Yeah.
Can you 1031 income real estate to income investment like this? Most likely not.
No, but I have groups already in our portfolio that we could, I'm happy to, introduce you if you're trying to put some 1031 to work. This is not really a 1031 opportunity, but again, like some of the real estate funds that we've invested in, they would happily do a deal, to work with you guys.
And you mentioned this earlier, but we have some firms, like some bigger family offices, that think they're considering right now coming in. One of the things they love is, hey, we want to invest into Fund Launch Partners, and also we would love to add some more to the real estate portfolio of the underlying businesses. And we say, great. So they come into Fund Launch Partners, and then they also say, we're going to write a check into SAC or these other real estate funds that we have in our portfolio. We say, great. So to 1031 money, if it was a decent commitment, that might be an opportunity for some of our portfolio companies we have down below.
Yep. Exactly.
Great job, y'all. Final questions. I think
let's wrap up. Let's close it out. Guys, thank you so much for coming on today. Again, we are closing this, this fund out. Would love to chat with you if you think this might be a fit for you guys.
Again, final call. You have to be an accredited investor to join this. We have to verify that you're accredited, by the way, because we're a 506c fund. If you'd like to learn more, get documents, get data room, there's that QR code. We'll book a call. You'll meet with one of us. We'll talk through where you're at. LOIs, it's a letter of intent, are due next Thursday, where you will say, I'm interested for this amount of money. Final call is the 28th, March 28th, and we are looking to close this fund. We strongly believe we're going to be oversubscribed. We're almost subscribed right now. We might be oversubscribed before the 13th, but we're looking to allocate. We wanted to make sure our community had a chance to be involved with us. We think this is phenomenal. I'm investing in this, as Mason is, Lincoln is. We all have our own chips in this. We are, if you saw Lincoln's passion earlier, this is a phenomenal opportunity. There's a reason Tony Robbins wrote a whole book on this. There's a reason Greenwich Economic Forum did a full day on GP stakes. This is an amazing asset class, and we are uniquely positioned to do well with it. We're biased. We think we're pretty awesome, but I think we're biased for a reason.
And I just want to thank everyone for taking the time today to hop on and hear about this opportunity. If we can be of value or service to you guys in any way, shape, or form, don't hesitate to reach out. We appreciate this community, and are excited to keep building it and supporting these managers. Thank you, everybody. Have a great day.